Hi, I'm Wayne Blanchard. I am a certified financial planner and a member of the Garrett Planning Network. Our topic today is loan collateral tips. Now, what we're talking about is, all right, you need to go borrow some money. What are some thoughts on loan collateral that might help you understand how's a little bit better way to do things? First of all, you need to know how much anything that you might be willing to pledge as collateral is really worth. So keep detailed records of any asset that you've got in terms of being able to tell what it's worth. Because if the lender values an asset for you, I'll guarantee you it's nowhere near what you think it's going to be worth. Now, bear in mind that a lender is not going to lend you full value of anything that you have, but sometimes it's very important. Let's take an appraisal on a piece of property, especially given what has happened in the real estate market over the last several years. It's very difficult to tell what a piece of property is really worth. So if you have a couple of appraisals done on a piece of property that you are going to use as collateral, and the bank has somebody else that has hired an appraiser to give a value on the property, quite possibly theirs would come in low, yours may come in higher, and you can negotiate a little bit different price. But you need to know what the value of your own collateral is to start with. Second thing is always know what you can actually use as collateral. Now, there are different kinds of things that you could use as collateral, and what I want you to think about in terms of what collateral the bank would want, and then you can decide what to use. To a bank or a lender, the more liquid the collateral is, the better. And the higher amount that, if it has a nice stable value, the more they will lend you on it. For example, let's take a savings account. A savings account can be collateral for a loan. And pretty much if you want to borrow money against a savings account, all you've got to do is go in and do it. Because they know how much it's worth, and they know that it's very liquid if you default on the loan. On the other hand, let's talk about something that goes down in value on a constant basis, an automobile or a boat or something. As soon as you obtain it, it's going down in value. So the lender has to make sure that as it goes down in value, that number one, if you default on the loan, they've got to find it, they've got to pay somebody to come and get it, and then they have to dispose of it. So they're not going to loan you that much because they know that it's going to cost a lot of money to get it back. It surprises a lot of people to understand that most of the time, they used to be the standard of lending in terms of loans, which you had to put down 20%. Now that 20% isn't just a figment of somebody's imagination, because it costs about 15 to 18% to foreclose, fix up, and sell a home once the buyer has defaulted on those payments. So that's where that comes from. So think about how much money and how liquid it is. Now, that goes into the third point, is you get to understand what the bank's risks are, and that's where I'm talking about. They're not going to give you full value because they know how much it's going to cost to actually get rid of that collateral if they have to take it. And then maybe, if you are well prepared, you can negotiate what collateral they'll take and what kind of terms they will give you for it. So those are just some tips on using collateral to get the best loan.